Hello everyone and welcome to the weekly Dorsey report. Today is Monday, January 5th, and we are officially in 2015. So what is going on? Well, we're definitely seeing some risk-off market action today, but looking a little bit longer term, I'm seeing a lot of similarities between this year and 1998 for those of you who were probably around back then during the throes of the tech bubble, at least the early and good part of it. But the big feature from 2014 was oil being down almost 50%. And the Value Walk site does an interesting study on the last 7 cases where this has happened, with oil being down at least 35%. And we have 1986 through 88, 1991, 94 through 98, 01, 08, and then now we've got our current case here. And so they all feature oil being down significantly. And actually in 3 of these 7 cases, it even led to a recession within 1 year. So there is a possibility, even though it's not a probability, I should say at least not a strong probability, that oil crashing by itself leads to a recession. In fact, in a lot of these cases, we can actually see within the next 12 months, S&P was up 25%, 26%, 11%, 16%, 40%, down 20% in 01. So in one of these cases, we had a big crash that was coincident with the tech crash following within 12 months of oil collapsing. And then in 08, we were down about 7% as well. And that was just the beginning of the financial crisis. So depending on your macro secular views of what financial markets are doing, it could be the case that we're just in a new regime since 01 and 9/11 and the first big financial crisis with the tech crash. So if we're in that new regime, perhaps we are headed for recession. Perhaps the U.S. equities markets will sell off. But if we keep within the precedent of the last few decades, then that means that the odds are actually less than 50% that the S&P will not rally and that we'll have a recession. So sort of cautiously bullish stance despite what oil's doing. As far as what the actual markets are doing here, we have our S&P 500, sorry, our SPY ETF representing the S&P 500 candles. And looks like we have been in somewhat of a downtrend. We're looking at the 30-minute chart here. Momentum, however, looks like we have made a higher low on the MACD, so that's a positive sign. The RSI is still down at 30, so that means downside momentum is locked in at least for the next week. And in terms of our relative assets, we have the 30-year U.S. long bonds in dark purple here and gold both outperforming pretty handily. Even high-yield bonds are outperforming in red. So that's actually a positive sign, especially since the high yield on a relative basis is coming in above our green key June baseline there and the 33 kind of royal purple EMA. So the fact that it's saying that this is basically where large cap U.S. equities risk should be is in line with the high yield bonds. So if that were to converge, that would take us above the sort of key pivot level here at about, let's go ahead and switch up to a non-percentage basis. So that would take us to about 204.2. So that's a key level we want to keep an eye on to have any kind of bullish action. We do have the gap that was created from the open, so that area will likely fill if we do end up having a rally. So it's very important that we push above this low 204 area and continue to rally into the positive phase of the Ichimoku cloud. And given our standard intervals here, we're going to be looking for upside action within 16 bars, so we're definitely past that threshold. So basically, if we do end up getting a few closes here above at least our conversion, our white conversion dot here, and we'll say the 20 Bollinger at about 203. Those will be the initial positive signs, but really we do want to see the RSI come up above 50 and see price action put in a couple candles above this 204 area. So in terms of the VIX, looks like we are flirting with 20 yet again. However, we have seen the VIX making a series of lower highs over the last few months, so that is a positive sign. Momentum, however, is trending up, and price action has printed a couple candles above that, so we're basically at a stalemate here between momentum and what the overall price structure is telling us. One of the key things is the 8-day rate of change, and that is positive and rising, so that tells us that the VIX momentum is definitely to the upside. So we can expect volatility to be elevated for at least the next week. And in terms of major horizontal levels, looks like we might be looking for resistance around 21, and maybe some support or pivot around 17.5, 17.6 maybe on the VIX. So levels to keep an eye on. But for the time being, as long as we're above these moving averages, expect the VIX to remain elevated. And because we printed our last closing low just a few days ago, 6 trading sessions, you really want to wait between 9 and 16 trading sessions of VIX rallying above that key 33 EMA before you start selling volatility and going long risk. In terms of our overall asset performance, looks like those long bonds, which I did recommend recently, are doing very well. And China, surprisingly, is doing well as well, and utilities, and these are all on a 1-month basis. As far as the ones that we want to stick with, we're looking for relative strength, and the U.S. long bonds are the only one that has that. We want relative strength of at least 55, but usually greater than 60. And so we've got that with TLT. We've also got that with the U.S. dollar, the UUP, as well as nice 1-month performance, and we're above our 50-day moving averages. And then in terms of weakness, we are looking at some of our worst performers are Coke, which is never usually a good emerging market sign just because so much Coke's revenues are derived globally outside of the U.S., but also considerable weakness in Europe, silver, Japan, emerging markets. Looking at RSIs, we're looking for below 55, but preferably below 50. Looks like any one of these you could stick with on the short side. These are all definitely sellers, and they're all definitely below their 50-day moving average. The last criteria as far as value would be anything that hasn't really sold off so hard on the quarter. So it looks like Japan is still there, Coke is still there, and EFA, sort of the global developed large caps, is also there. So those would give you kind of the best bang for your buck on the downside. Alright, as far as our sectors go, we're looking at our end of week implied volatility in this column. And percentiles for basically our major sector ETFs. And what these are telling us, essentially, the higher these are, the more viable those ETFs and sectors are. So it looks like at the top of that list, we've got XLV, healthcare, and XLU, utilities, up in its 99th percentile. XLU did get sold a bit last week, so it looks like right now we're getting a good relative buying opportunity on it. Also seeing some opportunity in XLK and XLI, so that's technology and industrials. Also XLE, energy, which has basically been on a buy for months now, but it's always reassuring to see that it's in the upper percentile of the last 600 trading days worth of options activity and volatility. In terms of kind of the lower side of things, which makes them more sellable and more shortable, we've got the XLF, the financials, also fairly low, the 60th percentile, 65th percentile, XLY, consumer discretionary. So Just to rehash, looks like good opportunities in utilities versus financials. Basically, that's a solid pair right there, which tells you that we're still in the bear market part of sector rotation. As far as what the CSuite is telling us right now, it's like as of the end of today's action, the S&P is substantially lower than the actual model, but that's to be expected because our expected variance has been dropping. Right now it's near the bottom of its range. However, we're well below our level now, as we can see on our actual table chart. So given fair value is way up in the 2100s, this looks like a good buying opportunity if you're looking out in terms of weeks toward the end of the month. But we should expect to come in a percent or two below the target low of 2048 on the 8th, going into the 8th. So we could definitely be scraping the lower 2000s before we finally have a huge rally out here that's expected over the next few weeks. So definitely a buying zone right here. Just be frugal about where you decide to enter. But right where we are looks like a decent spot. And then just to take a quick look at what the 3 and 5 day models are saying. 3-week model is looking at 2% gain over the next 3 weeks. And the 5-day, 1-week model is looking at a gain of 2.3% over just the next week. So big gains at both of those intervals, while our volatility remains elevated, which generally signals a risk buying opportunity. So definitely a bullish bias, despite the fact that we still need to consolidate and establish a bottom here in the S&P 500. In terms of what could give us that consolidation bottom and huge bounce, well, looks like we're on Fed watch this week. We've got an FOMC meetings release at 2 o'clock Eastern time coming up on Wednesday the 7th. So that almost always is bullish, and then it's followed up the next day on Thursday by FOMC member Coach Lakota speaking. So generally when you see that kind of a 1-2 punch, it's almost guaranteed to be to the upside. So being long risk, covering your shorts during that window is probably going to be a good plan. Also something that provides some positive seasonality boost is earnings. We have Alcoa, the typical kickoff, coming next week, January 12th. But also a lot of big names, KB Homes, CSX, also the banks, JP Morgan, Wells Fargo, Sallie Mae, Morgan Stanley. Those are all coming up next week for earnings. Typically with earnings, you definitely want to buy the rumor and sell the news. So just be long during earnings. It's generally a winner almost every single time. And if you do need to hedge your risk, just raise your cash levels, raise your bond holdings, those U.S. long bonds, or kind of tactically buy puts on, say, one of the weaker sectors like XLF. So I hope you guys have a great week, and I will see you next time.